December 23rd, 2025, silver just shattered every ceiling in its history. $69 per ounce. Not a typo, not a glitch. The highest price ever recorded, surpassing even the inflation-adjusted Hunt Brothers peak from 1980. And here's what makes this moment different from every other silver rally in the past 45 years. This time, the fundamentals aren't just strong, they're screaming. But the question everyone's asking right now isn't whether silver is valuable, it's whether you're already too late. Is $69 the beginning of something much larger, or is this the euphoric peak before a brutal correction? And more importantly, if you're sitting on cash right now, watching silver hit all-time highs, do you buy at $69, or do you wait for a pullback that might never come? I'm not a financial advisor. This isn't financial advice. I'm not telling you to buy or sell anything. What I'm going to do is walk you through the data, the patterns, the supply and demand dynamics, and the historical precedents that explain how we got here and where we might be going. Because understanding this moment requires more than headlines. It requires context. Let me show you exactly what's happening right now, why silver hit $69, what the historical patterns tell us about buying at all-time highs, and what the supply crisis, industrial demand explosion, and monetary dynamics suggest about where silver goes from here. This is pure analysis, based on publicly available data, historical patterns, and market mechanics. You'll make your own decision, but you'll make it with complete information. The rally. How silver got to $69. Let's start with the timeline, because this rally didn't happen overnight. It built over months with specific catalysts at each stage. January 2025. Silver started the year at approximately $30 per ounce, relatively quiet. Industrial demand steady, investment demand moderate, nothing suggesting what was coming. March 2025, first catalyst. The United States Mint announced temporary suspension of American Silver Eagle production. The reason given was supply chain disruptions. But industry insiders understood what that really meant. The mint couldn't source enough refined silver blanks to meet demand. When the world's largest sovereign mint can't produce its flagship coin, that's not a supply chain issue. That's a supply crisis. April through June 2025, silver climbed steadily from 30 to 42, a 40% gain in 3 months. The drivers were clear. Solar panel installations hit record levels globally. Electric vehicle production continued expanding. 5G infrastructure build-out accelerated. Every major industrial sector consuming silver was growing simultaneously, and mine production wasn't keeping pace. July 2025, second catalyst. China reduced its U.S. Treasury holdings to $731 billion, the lowest level since 2009. Simultaneously, central banks globally purchased over 100 tons of gold. When central banks diversify away from dollar assets into precious metals, markets notice. September 2025, silver broke through $50 per ounce, exceeding the 1980 inflation-adjusted peak for the first time. This was psychological. The barrier that had held for 45 years was broken, and once broken, the technical picture changed entirely. November 28, 2025, the CME Group experienced a reported server cooling issue causing trading outages for over 10 hours. During that outage, silver spiked to $56.72. When systems came back online, bid-ask spreads were over $1. That's illiquidity. That's what happens when a paper market faces stress and physical demand overwhelms available supply. December 2025, the final surge. Silver went from $56 to $69 in 3 weeks. Reports suggest JP Morgan reclassified approximately 13.4 million ounces from registered to eligible status at COMEX, removing deliverable silver from the market during peak demand. Federal Reserve rate cut expectations hit 87% probability. Dollar weakness accelerated, and silver exploded. Today, December 23rd, 2025, $69 per ounce, all-time high. And the question everyone's asking, is this the top, or is this just the beginning? The historical pattern. What buying at all-time highs actually means. Here's what most people get wrong about all-time highs. They assume that buying at a record price means you're buying at the top. But history tells a different story. Let's look at gold, silver's larger sibling, because the patterns are instructive. In September 2011, gold hit an all-time high of $1,923 per ounce. People who bought at that peak endured 12 years of decline and consolidation. Gold didn't exceed that level again until 2020. That's a brutal lesson in buying euphoria. But here's the other side. In December 2020, gold broke through $2,000 for the first time. All-time high. People said it was too late. Yet by December 2025, gold sits at approximately $4,200 per ounce. Anyone who bought the 2020 all-time high has doubled their money. The difference isn't luck, it's fundamentals. The 2011 peak was driven by fear and speculation following the 2008 financial crisis. By 2012, that fear had subsided. Central banks were stabilizing. The crisis passed, the buying pressure evaporated. The 2020 breakthrough was different. It was driven by structural changes, unlimited money printing, negative real interest rates, rising inflation, currency debasement, and central bank accumulation. Those fundamentals didn't reverse, they accelerated. That's why gold didn't correct, it doubled. So which scenario is silver in right now? Is $69 like gold in 2011, driven by temporary fear that will fade? Or is it like gold in 2020, driven by structural forces that continue intensifying? The data suggests the latter. The supply crisis. Why this is structural, not cyclical. Let's talk about supply, because this is where the silver story becomes undeniable. Global silver mine production has been declining since 2016. According to industry reports, production fell approximately 7% from peak levels. This isn't temporary, this is structural. Why? 3 reasons. First, primary silver mines are depleting, ore grades are declining. Fresnillo in Mexico, the world's largest primary silver producer, cut production guidance by 8% in 2025. Not because they wanted to, but because the remaining ore requires more processing for less metal. Pan American Silver delayed expansion projects citing capital constraints and permitting issues. When the largest producers are contracting, not expanding, that's a supply problem that doesn't fix quickly. Second, 70% of silver comes as a byproduct from copper, zinc, and lead mining. Silver supply is therefore dictated by base metal demand, and base metal prices have been choppy. Mining companies don't build new copper mines to produce silver. They build them for copper. If copper economics don't justify new projects, those projects don't happen. And the silver that would have come as byproduct never gets produced. Third, recycling isn't solving this. Electronics recycling recovers only about 18% of silver used in devices. Solar panels lock silver away for 25 to 30 years. Industrial recycling achieves maybe 50% recovery rates. The math doesn't work. Recycling adds approximately 150 million ounces annually. Global consumption is 1.2 billion ounces. That's a 1 billion ounce gap that must come from mining. And mining is flat to declining. The Silver Institute reports a structural deficit running 7 consecutive years. More silver consumed than mined every year since 2018. That deficit has been filled by drawing down above-ground inventories. But inventories aren't infinite. COMEX registered silver, the deliverable supply backing futures contracts, stood at approximately 113 million ounces as of November 2025. That sounds significant until you realize annual investment demand alone is around 250 million ounces. If even half of that demand wants physical delivery, COMEX doesn't have enough metal. This is why mints are suspending production. This is why premiums are spiking. This is why silver hit $69. The supply crisis isn't coming. It's here. The demand explosion. Industrial consumption that cannot be replaced. Now, let's talk about demand, because silver isn't just an investment, it's an industrial metal with applications that cannot be substituted. Solar panels require silver paste for conductivity. Every panel contains approximately 20 grams of silver. Global solar installations doubled in 2024 and are projected to continue growing 30% annually through 2030. That's an additional 150 million ounces of annual silver demand from solar alone by 2030. Electric vehicles use approximately 3 times more silver than traditional combustion vehicles. Every EV contains roughly 25 to 50 grams of silver in various electrical components. EV production increased 40% year over year in 2024 and is expected to continue growing as governments mandate electrification. That's another 50 million ounces of incremental annual demand by 2030. 5G infrastructure requires silver in antennas, circuit boards, and connectors. As 5G deployment expands globally, particularly in developing markets, silver demand from telecommunications is growing 15% annually. Medical devices, AI data centers, defense systems, consumer electronics, every technology sector is consuming more silver. Industrial demand hit approximately 680 million ounces in 2024. Projections suggest 750 million ounces in 2025. That's 70 million ounces of increased consumption in 1 year. And here's the critical point. Silver cannot be substituted in most applications. Copper is cheaper, but less conductive. Gold is more conductive, but prohibitively expensive. For the sweet spot of conductivity, cost, and availability, silver is irreplaceable. When you have declining supply, meeting accelerating demand in a market where the product cannot be substituted, the price must rise. It's not speculation, it's math. The monetary dynamic, why silver follows gold. But faster. Silver has always been gold's volatile younger sibling. When gold moves, silver follows, but silver moves faster and further in both directions. The historical gold to silver ratio averages around 15.1 over centuries. During the 20th century, it averaged 47.1. Right now, with gold at approximately $4,212 and silver at $69, the ratio is about 61.1. That means silver is still undervalued relative to gold by historical standards. If the ratio returned to even 50.1, silver would be at $84. If it returned to the long-term average of 47.1, silver would be at $89. But here's what makes this moment particularly interesting. Gold is primarily monetary. Silver is both monetary and industrial. When both demand drivers activate simultaneously, investment demand from currency fears and industrial demand from technology, silver becomes uniquely positioned. And that's exactly what's happening right now. The Federal Reserve, rate cuts and dollar weakness. The Federal Reserve meeting on December 17th to 18th, 2025 resulted in a rate cut. According to market data, the probability of further cuts through 2026 remains elevated. When interest rates fall, two things happen that benefit silver. First, the dollar typically weakens. Silver is priced in dollars globally. When the dollar falls, silver becomes cheaper for foreign buyers. Demand increases. Price rises. Second, lower interest rates reduce the opportunity cost of holding non-yielding assets. When bonds pay 5%, holding silver means sacrificing that yield. When bonds pay 2%, the sacrifice is smaller. Investment demand for silver increases. The combination of dollar weakness and low interest rates has historically been the most bullish environment for precious metals. And we're entering that environment right now. The paper market stress, when promises meet reality. Here's the part that should concern anyone holding paper silver instead of physical. The COMEX silver market has approximately 244% open interest relative to vaulted supply, according to recent data. That means for every ounce of physical silver in COMEX vaults, there are 2.44 ounces of paper claims against it. And if the supply crisis worsens, those premiums could go to $15, $20 or higher. During the March 2020 panic, premiums hit 60%. If that happened today, physical silver could trade at $110, while spot is at $69. The verification problem. One final consideration. If you're buying physical silver right now, counterfeits. When supply is tight and premiums are high, counterfeit products flood the market. Fake American silver eagles from China, tungsten core bars with silver plating, sophisticated fakes that fool casual buyers. If you buy physical silver at $69 plus premiums, buy from established dealers. Verify authenticity with proper testing equipment. Don't trust suspiciously good deals from unknown sellers online. The worst outcome is not buying silver at $69 and watching it pull back to $60. The worst outcome is buying fake silver at $69 and discovering your $10,000 investment is worth $500 in scrap value. The final analysis, what history and data suggest. Let me bring this together with what the historical patterns and current data suggest. Silver at $69 is at an all-time high driven by structural supply deficits, accelerating industrial demand, monetary debasement, and paper market stress. This is not the 2011 speculative bubble. This is a fundamental supply-demand imbalance that's been building for 7 years. The case for waiting assumes this rally is temporary, that supply will increase, that demand will moderate, that the fundamentals will reverse. None of the data supports those assumptions. Mine production continues declining. Industrial demand continues accelerating. Monetary policies continue favoring hard assets. The case for buying now assumes this rally continues, that supply remains constrained, that demand continues growing, that the fundamental forces remain in place. All of the data supports those assumptions. Does that mean silver can't pull back from $69? No. Silver is volatile. A 10% to 20% correction is always possible. But waiting for that correction means risking that it never comes, or comes at $80 down to $69, meaning you waited and still bought at current levels. What you should consider, I'm not telling you to buy silver at $60. I'm not a financial advisor. This isn't financial advice. What I am telling you is this. Understand the fundamentals. This isn't speculation. This is supply and demand. Understand the historical patterns. All-time highs driven by structural forces have continued higher. All-time highs driven by temporary emotion have corrected. Understand the timeline. If you believe silver is going significantly higher over 12 to 24 months, then buying at $69 versus $62 doesn't matter much in the grand scheme. Understand the risks. Silver is volatile. You could buy at $69 and watch it fall to $55, but you could also wait at $69 and watch it rise to $85. Understand the physical premium. Spot price is $69, but physical costs $75 to $79. That spread matters. Understand the verification requirement. Only buy from established dealers. Test everything. The bottom line, December 23rd, 2025. Silver at $69, all-time high. Supply crisis accelerating. Demand exploding. Monetary debasement continuing. Paper market under stress. Is this the top or is this the beginning? The data suggests this is structural, not cyclical. The fundamentals suggest higher prices ahead. The historical patterns suggest buying all-time highs driven by real forces works. But the decision is yours. Not mine, not any analysts, not any gurus. Yours. You can buy now and risk a pullback. You can wait and risk missing the continuation. You can split the difference and scale in gradually. What you cannot do is ignore the fundamentals and pretend this is just another rally and just another commodity. Silver is at $69 because the supply cannot meet the demand. That's not hype. That's math. The window to act exists today. Whether it exists tomorrow, next week, or next month depends on forces neither you nor I control. What we can control is whether we understand the situation and position accordingly. Silver at $69, all-time high. The question isn't whether it's high. It is. The question is whether it's going higher. And everything I've shown you suggests the answer is probably yes.